So I want to present today about optimization and how it is used in finance, both the practice side and the challenges. Well, the challenges are a little bit short. I mean, what to talk much about problems you haven't solved yet, but in particular, also focusing on the practice side of how things are put in at work in the finance sector. Let me just go on here. So here is a brief outline of the talk I want to provide. First, it's about the introduction of the terms and what the financial industry is actually looking at and what they are optimizing. Then followed by the practical needs and the techniques that I use to tackle those questions that are to be solved by optimization. Then the brief overview of problems that are still out there for optimization research to tackle, and in which directions to drive on, which could be useful for the practitioners. And then, since in finance everything turns around the so-called alpha, I'll introduce what this is, but then I'll also address the question on what might potentially shrink the alpha, because shrinking the alpha is something that is not very much liked in that industry. So it's obvious that people want to avoid anything that can shrink. So my brief curriculum vitae was already presented. The only thing I want to mention here is I joined Axioma in 2007, which was at that time, entirely focused on the analytics side of the business, which is, the optimizer and analytics in the financial space. Meanwhile, we have been actually purchased by the Deutsche Börse Group, as you can also see from the bottom line, and put together with two index providers, STOXX and DAX, into a new company called Qontigo. So for those interested, this is the analytics part of Qontigo in a nutshell, leaving out the index part. We have quite many customers. Meanwhile, we have a lot of money that is daily optimized and daily handled through our tools. And quite many professional users, which apply not only the optimizer, but also risk models which we produce and analytic factors, as you can see there. Our company has always been quite heavy in research and development. This is more on the practitioner side, but obviously also on optimization. We have our own optimizer that we tailored and tuned for the needs of this industry. So let's go first into what are they really looking at and what is the alpha. So in finance, you will easily find a lot of different application fields, which is where optimization and mathematics can actually be used. So the credit business, loans, mortgages, and so on, everyone knows there is stochastic modeling behind that. There is the pricing of instruments, especially the more complex instruments. And if you think back, everyone probably heard terms like CDS about 10 years ago. Those are pretty complex investment vehicles, and modeling them properly will require a lot of stochastic and numeric methods and models. Of course, there is running the exchanges and organizing the trading through market making, brokerage, and so on. Even up to the point that auctions, you can apply auctions models on dark pools and trading platforms out there. M&A, obviously, mergers and acquisitions, is something that is more operational, so there is less optimization involved, but it's still quite some strategic business there. And then, of course, the interbank business, monetary policy, where it gets a little bit more into politics, is also using economic models, and everything as an economic model is based on some sort of math. Optimization is used in most of those areas, but what we focus on are problems from portfolio management. We started off with equity portfolios. Meanwhile, we do it across the board. But for the sake of simplicity, I want to stay with equity portfolios for the most part here. Basically, all what I will present will carry over to other other non-equity portfolios or other asset classes as well. But it's just easier for equities to stay there. What is that? What is a portfolio? This is a given set of asset stocks that you can buy on the market, and you want to determine how much to invest in each of those. It's a combination of selecting names, so which stocks do you want to buy and which not, and the sizing of how much you want to put into them. We generally also distinguish between so-called fundamental management. This is from people like Warren Buffett that you might have heard when they apply value investing, versus quantitative portfolio management, where a lot of the methods that we use, including optimization, are entering the scene. And then there are many characteristics that you can consider: concentration, leverage, risk, transaction costs, and so on. So it's worth to clarify some of the terms first. And I mentioned already that alpha is one of the key terms there. So what is alpha? There are, of course, many different ideas that you could apply to what alpha could be potentially, and some of them I have shown here. And there are also ideas, of course, what can lead to potential shrinkage of alphas, which is shown in those pictures. But this is, of course, all nonsense. It's not the alpha that financial institutions are using, although the fast cars they like as well. But what they are really meaning is, one of those terms that are important for portfolio construction. The alpha is simply the excess return of an investment asset. Excess means it's on top of the risk-free rate. So you would only invest into something if you get a return that is above what you could get without any risk be taken, right? If you put your money simply on your account and see growing there. But that was for times when there was actually growth on money. It's currently we are in a low interest rate environment. So, at best you keep your money stable, but most likely you will lose some of it if you just let it lie around. Anyway, so the alpha is the excess return. And that is obviously the key targeted aspects. Everyone is trying to do processes and investment methodologies that grow the return. Beta is market sensitivity, rather technical. I don't go into that here. Portfolio is the summary of all the assets that you decided to hold in your books. And usually this is measured against the benchmark, which is typically a public index that you just use as a benchmark for your returns and for your performance in general. Holdings and weights, usually you invest in currencies, but typically what practitioners do in finance is that they scale by the total holding and then you only talk about percentage weights in relative positions. Then obviously there are trades. There is something called market impact, because if you want to trade, like say 5 million shares of Apple at one time, then you will move the market with it. And this is what's called market impact. So there is a certain shortfall in the price that you will suffer from in large trading. And so this is also something that's taken into account. But then there is one term that's quite critical, which is risk. I come to that in a second. There are some concepts that might not be very familiar. So briefly talking about that, what's shorting? Shorting is if you take a negative position in an asset. This is a bet on the price of that asset to fall. So you actually borrow that asset from someone else and you hope you can give it back at a smaller price, and then you would make a profit from that. Portfolio strategy is a set of rules and goals that you want to use to manage a portfolio. I'll show some examples later. A backtest is a historical simulation. So you run your ideas of how to manage the portfolio through the history and see whether it would have done any good. Diversification is a quite critical term, which is you try to exploit correlation effects between different holdings that you can have in your portfolio so that you reduce the risk. Because if you manage to get two assets where the one is growing when the other is falling and vice versa, then you will always stay at a certain level. And obviously you try to get this done in a way that it still grows in combination. And then there's a term of hedging where you use similar effects, diversification in particular, to reduce the risk in your portfolios. So I've mentioned risk a couple of times. What is it? What is risk? This actually is one of my favorite questions in interviews of candidates because it's not easy to answer that. And if you ask practitioners in finance, you typically hear something about losses or the probability of losses, which is also true, but it's a very one-sided view on the world. And one of my favorite follow-up questions, if they give me a good answer on the first one, is, can there be a situation where too much revenue is also risk? And in fact, there can be. But I can mention this later. So first of all, the most general answer on what is risk is the chance or the probability to miss an expectation, whatever this expectation might be. In finance, there are different measures for risk, actually. that are used. So the most simple one is, or the most widespread one also, is volatility. So you just measure the dispersion of a distribution. That is symmetric. So it doesn't distinguish whether you deviate to the downside or the upside. It just measures that you deviate from a certain expectation, which is the mean value. Then there are loss risk measures. That those would now be the one-sided ones. You have, tail risk. You have one-sided risk. You have so-called value at risk, which is, measuring the tail risk side of things, and variants of that. I mentioned those later. There is something called a drawdown, which is simply the difference between historically the highest and lowest values that you have. So how much could you basically lose in one dive down? And then there are asymmetric risk measures, usually connected to instruments that have optionalities in it, like options and other derivatives. So what we do in optimization is actually we stick to the simpler measure for risk, which is volatility, and that is measured by risk models. So what is a risk model? A risk model is basically a covariance matrix that measures historically how different instruments have related to each other. So how they are correlated. And then, in the diagonal, you have the variances. So what was the fluctuation of prices of each of the assets? So that's basically the core. And such matrices are positive semi-definite. So they can be used in optimization in standard methods. I come to those in a second. But this is how risk is measured. In variance or standard deviation terms, you simply take the vector of positions and you multiply it to this covariance matrix. And that gives you a number that is the risk of your portfolio. There are different types of models. So what I've described so far is what we call a dense model. It's a full asset-asset covariance matrix, but that's not practical. If you think about it, we have clients that use universes of 50, 60,000 stocks, and you certainly don't want to handle a 50, 60,000 dimensional matrix. So what is more prominent is the so-called factor model. And this is mathematically a dimensional reduction approach, but it also has some meaning financially. So what you do there is you pick a small set of factors that represent key economic measures. And you then reduce the covariance measurement only among those factors. And you measure how much each asset is exposed to each of those factors through the so-called exposure matrix. And then, because this smaller set of factors can't obviously explain all the variability in the asset returns, so you remain with the specific risk, which is the residual from regressing the factor covariance matrix, or the factors you regress out the factor returns, and what in the return space can't be explained by those fewer factors, you put into the specific risks. So this is what then finally a risk model is looking like. You have the systematic part, which is measured by the factors and its covariances. And then what's not explained there is the residual, the idiosyncratic risk. And the risk is, portfolio risk is then calculated in exactly the same way as before, because you could, if you just multiplied this all out, you would get to an asset level covariance matrix as we have seen before. You now just get the systematic part and the idiosyncratic part separate. So this is how risk is measured. And then there are two different approaches for factor risk models. The one is fundamental factors, where you predefine the factors and you give them some financial meaning. Or there is a statistical way of doing that, and you derive the factors from a PCA method. So what are typically fundamental factors? We have style factors, and they are the most important ones. There is something like size, which simply measures the size of the enterprises or the stock issuers. You have momentum. How did the price behave in the past? Did it show a trend? You have volatility as a factor, and then there is value growth and other factors that simply have economic meaning. And people use those numbers also irrespective of optimization, but they, since you have quantified entities here, you can perfectly use them in something like optimization. Then there is usually a market factor just as an intercept. And then you have a lot of classification factors. You look at different industries, countries, currencies, and so on. And this is basically forming an economic, meaningful representation of the stock market and the portfolios. Statistical factors, there you use PCA methods, as I've mentioned. Those methods, those factors that come out of that measure the major components. It's a principal component analysis, but they don't have any financial meaning or economic meaning to humans. So you need to translate that also. But the advantage that statistical factor models have is they can pick whatever drives the market, even if you have not predefined it in those economic meaningful factors. And so people like to look at those as well, because they can pick up patterns and things in the market that the other factors can't. So we offer them actually both, because we have decided not to be religious about the methodologies. We offer our clients both such factor models or types of factor models, so they can choose what they prefer, and they can look at them in comparison as well. Now, all that is going into investment strategies. And so here are some classical concepts. You have active versus passive portfolios. Active means that people are trying to make predictions about future returns and use them in the construction of portfolios, versus passive portfolios do not do that, but they basically pick some idea, usually in an index, and create portfolios that mimic that index behavior as efficient as possible, so cost efficient as possible. Then we have long only versus long short and extension strategies. What this means is long only is the classical approach. You buy something and then you hold on to it and you hope to sell it at a larger price at some point. Long short is allowing or including the shorting component. We can also bet on falling prices, which long only can't, right? If you have a long only portfolio and you buy something, if the price falls, you can only sell it to lower price than you bought it, so you have a loss. You can't bet on falling prices. In long short, you can. And extension strategies are something like limited long short piece. So you go, you have a long only 100 invested portfolio, 100% invested, and then you allow for 30% short and 30% long extensions. That makes it to 130-30. You can go further. Hedge funds apply market neutral strategies where the net value of the portfolio is actually zero. So you have as much short as you have long. And by the way, this way you can also finance your portfolio, because for everything that you sell short, you get some, the amount in dollars first, and you can invest it on the long side. So there are market neutral, dollar neutral, risk neutral strategies, and so on. Something that is currently gaining a lot of attention is factor investing. We have done this in quant finance since 20-30 years, but now they relabeled it as smart beta. And now it's flying actually with all the retail clients out there because it sounds so smart. And so they apply basically the same thing as before. And there is another trend that is also visible, is risk parity. So rather than being driven by return forecasts, you want to actually just balance the risks in your portfolio and keep them equal from different risk sources. And that is what constitutes risk parity strategies. And then there are, to realize those strategies, several components that you typically use in portfolio management. Most of them I've mentioned already. You have, positions, so you might want to limit them. You have a market sensitivity expressed by beta. You want to limit that. You have turnover, how much you trade in your portfolio. You want to limit that, and so on and so on. I don't go into those in detail individually, but here is how the process of managing a portfolio looks like. You get information from all sorts of sources, historical data, you get hot tips, you get your friends that tell you something. You could also get insider information, but you are not allowed to use them. But any sort of data that you can compile, you put into an estimation process. In that process, then you forecast certain things. The risk model is a forecast, but usually the financial institutions buy that from a provider like us or some competition, because they don't want to go through all this collection of all data and then crunching and maintaining all those processes. You buy the product. But typically alpha is something that they all do themselves, and it's their trade secret how they better forecast returns than the competition. All that is then put together with a strategy, your idea of how you want to run a portfolio, together with the data. You then optimize that, and then out comes the optimized portfolio. And this way of optimizing, that's what I want to first tackle now in the technique section. So Markowitz, as everyone might know, has put out in the 50s a seminal paper on portfolio optimization models. And here you see the 3 models that he has actually looked at. You can either minimize risk while you keep the return level lower bounded, or you can maximize return while you keep the risk at check with an upper bound. Apologies. And what he actually did is he put both of those terms into the objective function and then started to balance them off there, with the lambda being the so-called risk aversion. So that tells you how much return do you expect if you would be willing to accept a little bit more risk. And that is the key formula. That is what is called mean variance, not min variance, but mean variance optimization, because you try to take the balance between the return and the risk side there. So that's the classical problem. And as you can see, it is quite easy, because usually, I mean, this is just an example of constraints, but usually you have quite simple constraints there. The complexity is an objective function with a variance term. So it was tackable with methods at his time to solve such problems. This is what brought him to the idea to connect those 2 worlds and then introduce optimization into finance. One of the outcomes of his theory is the so-called efficient frontier. So basically, if you run the mean variance optimization either with different risk aversions or different bounds on return or risk, then you end up with something like that frontier here. If you would know in advance all values for the risk and the return side, then the pink line would be, that's the so-called true frontier. That is the trade-off and the set of efficient portfolios if you would know everything. But you don't know it. And so usually what you do with your estimates for return and risk, you overestimate. So you end up with a frontier that is above that line. And the portfolios look better than they actually will do. And so if you take the portfolios from your estimated optimizations, and then you apply the real values to them that actually constitute the pink line, you end up with the green line, because it turns out you can't be above the pink line with the true values. But since you misestimated and you overestimated the benefits, then you end up below the line. So that's the game on the efficient frontiers from Markowitz. There are certain issues with that approach, and let me give you a brief overview of what practitioners struggle with. So one is the shortcomings of mean variance optimization, as they have been documented in a lot of literature. So there's a lot of literature about this approach being actually not optimizing your return risk trade-offs, but actually optimizing the errors that you have, the estimation errors that you have in all your predictions. So is it really choosing the right assets, or is it intuitive also by what it does, or is it really just maximizing the errors that you have in your estimates? Is it over or underestimating the risk and return, as we have seen in the frontiers? It actually does, right? The second one is, even if you have the perfect information, is this properly transformed into the portfolio? Is it translated there in a way that you can recognize it? Or are other things like constraints that you put in, mandated constraints that your clients actually ask you to implement, are they taking away from that strength of your alpha? Are you potentially even forced to take bad decisions just by the mandate, although your alpha would have known better? So this is all issues that are about the transfer of the information into the portfolios. But there are others. There are trading considerations. How does the trading affect performance? Everyone knows that trading obviously costs money in different forms. How can you incorporate that? Now, this will be mostly also estimates, right? I mentioned already the market impact. You can only estimate that. You don't know. If you are lucky and you put out a 5 million Apple share sell order, and there is actually by chance just someone who wants to buy 5 million of them, then you will not move the price, but that rarely happens. So usually you will move the price, but you can only estimate on how much. And then there are obviously operational considerations. What is an implementable portfolio? Can you really put this in practice, or is this just mere theoretical thing? So what we need is the classic basic mean variance optimization model needs to be extended. And there are different ways of extending it. Of course, you have linear and quadratic rules on all sorts of measures that you can dream about. Some of them you see listed here. I don't want to go one by one through them, but it's just that you get a sense of what people are trying to do there. And those are all the simple things they try to do. Here is already a little bit more complex stuff, costs and taxes. So transaction cost models I mentioned, you want to have different combinations there, and piecewise linear costs, for instance, which grow by volume, is something very common. And then you have something that's fixed charge cost. So you pay a certain, they call it stamp duty or ticket charge, if you want to trade, irrespective of how much you want to trade. So just that they take on your form and start the process, you have to pay a certain fee. And that is not a marginal one. There, as you know, those financial guys, especially exchanges, are not shy. Then you have the market impact models. And this looks simple, but it is not, because you need to model them with different powers than you are usually using. Quadratic obviously is easy, that is covered by most optimizers, but then you need fractional powers. We have 3/2 and 5/3, for instance, at offer, and those are closer to the behaviors that you usually see. But from optimization perspective, you get into rotated cones there, and that is some additional complexity that not all optimizers will provide. Then you have taxes. We offer tax-aware optimization, where you can enter that you have long and short-term gains depending on how long you hold on to some investment. And then there are more complex things like the wash sale rule in the US, where you're actually not allowed to in too short distance to buy and sell an asset if that would come at a loss. People could do that just to claim the loss against their tax duties and then directly buy back that asset. And this directly buyback, that's prevented by the so-called wash sale rule. You can still sell and realize losses, but you can't just do it on book papers and then actually not have it really in your books. So you are prevented from buying back an asset that you sold for about 30 days or so. But this is just one of such rules, and there are many more. So if you get into the tax space, then it becomes already more tricky to model stuff. And then even more in combinatorial space. So there are certain things, thresholds, for instance, which is simply a minimum position size. You don't want to hold 2 shares of Apple. You want to hold either nothing or you want to hold 1 million plus of those shares. The same for transactions. You don't want to call your broker selling off 2 Apple shares. You have a minimum transaction size. And that is something that needs to be taken into account. And as you can see from the formulas already, it's a discrete decision. Do you hold or you don't hold? And if you hold, then you hold a certain amount. We have cardinality limits. So you want to potentially limit how many names you have in your portfolio, how many transactions you make. There is something that's called round lots. You are not allowed in all jurisdictions to trade any arbitrary amount, fractional by in no way, of course. But even in some, like in Japan, you can trade some stocks only in multiples of 1,000 shares, for instance. So that makes a lot size, and that, of course, turns the problem heavily combinatorial. Then you have conditional conditions, right? Like if then else, and combinations of those. I come to some later. So what do we apply today? At Markowitz time, as you can see at the bottom right of this slide, quadratic programming was the state of the art. So this is why he used mean variance optimization as this breakthrough. And it was a genius strike because it combined 2 different, formerly not collaborating areas of science, which is mathematics or optimization and economics. But today we have made, of course, large advancements in optimization. And so second order cone programming is what today is state of the art as we consider it, and can tackle problems of realistic size in finance. So this is what we also use. And then we add a discrete overlay to that, which handles all the discrete conditions that I mentioned, the combinatorial ones, right? Cardinality conditions, thresholds, fixed charge costs, and so on. But then there is also something that here in Europe, for instance, is important, which is the 5-10-40 rule, which is a conditional one that is not that easy to model. But as you can see, with the discrete overlay method that can model all those things, you can get quite far. I leave that out. That's just basically talking about how you match the features that you need and the benefits that you get from different approaches. We use them both in combination and And we do it in an exact way. So our methodology is still an exact solver, so that we can provide solution quality assessments to our clients as well. Because very easily you have combinatorics creeping into the problem. And then for, the usual patient span of a portfolio manager is about 5 seconds. And you can imagine on, 50,000 variables, what you can solve in 5 seconds. So you often give back not fully optimized problems. And then it's important to tell them about the quality of the solution and whether it would be worth to spend another half hour or so computation time. But then I want to talk briefly about some variants that we also apply, which is, for instance, ratios are, not rations. Sorry for the typo in the title. What we talk is ratios. So this is risk-adjusted return. You want to measure the performance by the amount of risk you take, because outperforming the market by 10% is not difficult to make, but you might potentially take huge risks for that. And so you want to adjust that, and so you take the ratio. So there's a Sharpe ratio, the information ratio, there are other ratios that economists have defined, so Tino ratios and so on. They are all of similar types. And the problem with those is that they are non-convex functions in general, because you have this quadratic term in the denominator. So they are not perfectly suited for solver approaches. But there is one thing about them that helps us, which is scale invariance. So if you look at the definition of such a ratio, whether or not you scale up the portfolio with a positive factor, tau in this case, you don't change the ratio. And so we can leverage the scale invariance to actually change the problem formulation by reformulating the ratio into fixing the numerator to a given number with an appropriate scale that you now allow the portfolio to take, right? So here is an example how we do this for a full strategy. It's a 1-30-30, so such an extension strategy. You see on the left side the original strategy, and on the right side the reformulated version, which is by using the scale asset, which becomes a variable, by the way, and then applying it accordingly. And those two problems mathematically are equivalent. The right one we can solve because it doesn't have any ratios or non-convex functions anymore. So we do this, and then we get the solution back by just dividing by this scale asset value that we get as a variable here as well. It doesn't work for a few components, thresholds, tax aware, and so on. But for most of the strategies that are used out there, it works. And so we can properly optimize such ratios as well, although they are non-convex functions. There are other modeling tricks that we need to apply in times. One of those conditions I've mentioned already is turnover, and there are lots of different variations that you can use to that. Most of them we have covered either directly. You can pick them from the library of conditions that we offer. And we have a business layer where we basically talk the language of the portfolio manager, and the business layer is doing the translation into the math problem under the hood. Or you can do it by, cleverly combining or, doing some surrogate formulations. One of them I've shown here. If you want to limit the total bias in a certain sector of the industry to be at most 10% of all bias in your rebalancing, then you can model it in the way as I've shown, and that is the condition that we can actually put into our optimizer. But then there will always be, whatever flexibility you offer to the users, there will always not be enough of it, and they will come back and ask for more things. So one of the questions that I was once asked is they wanted to model turnover as the minimum of all buys in all cells. That usually happens when they are not balanced, of course. If you have a fully invested long-only portfolio, then buys and sells will always equal. But in hedge funds, for instance, they don't. And so this is an alternative. Now, we don't have that, and we don't have the minimum function as one of the modeling things. And so one of my main tasks in the company is to work with our clients to work out whether such requests can be handled or not. And this one was a simple one because there is this formula for the minimum, and we have all of those different things. We have linear and absolute value functions, and we can also put in auxiliary variables. So in combination with those capabilities, we could model that request, and we could really put a limit on the minimum of buys and sells. That's not so fancy for you guys. Here is another one. I mentioned the 5, 10, 40 rule already as a conditional one, right? And the condition here is simply that you measure on issuers. You might have different stocks from the same issuer that is globally operating and listed on multiple stock exchanges. So you measure all your investment in one of those issuers. And the 5, 10, 40 rule says that no issuer can have more than 10% invested in it. And for all those where you are invested 5% or more, the total sum of that can't be more than 40. This looks like, technocratic, but it's actually important because it's one of the UCITS rules. So if you want to run a fund under UCITS compliance, which is a set of regulatory requirements, then you need to satisfy that rule. So it is really important for the practitioners to be able to solve that. And it's not easy, of course, as you can imagine, by just doing optimization yourself, because they are usually not experts in it. But UCITS compliance is important because once you have that compliance, nobody is questioning certain things anymore. So this ensures a certain diversification. You can't have too much of your portfolio concentrated. And then this leads to another one that came in. And here we really need much deeper maths, which I wanted to briefly show so that you understand that optimization can really contribute a lot here. So the question is, can you limit the top end positions, the total combined weight of the top 3 positions in my portfolio without predetermining an order of, the sizes? So yes, you can, but it's not as easy as it seems, right? You guys will know that this would usually then need 2 to the power of n different conditions, right? All those sub-elemental, n-elemental subsets of assets. But there is a smarter way, and it can be found in some of that literature here. For explaining that briefly, let me just get into how this is modeled. Assume first that we know magically how the portfolio weights will look like, right? Then we can look at them as parameters, and this simple linear problem will find us the top n positions, right? I can only pick n. I have to pick between 0 and 1, and then the sum is the weight sum of the picked ones. The key observation here is that this problem is totally unimodular, which means that all the solutions without requesting it will be integral. Now, every linear program has a dual program. You see it on the right side here. And we know from duality theory that for the objective functions, the dual problem will be greater or equal than the primal problem objective value. So if we want to limit the top end position weight, which is now on the left side, we actually can do this by the right side here. And this is the objective function of the dual problem. So what you can do is, you can add this additional modeling, which is just constraints, into your portfolio construction. You need some auxiliary variables, the PIs and the Q. And then you can put a limit on the top end positions, which are not predetermined. And this is getting really deep into optimization theory with this trick about duality theory and so on. So the economic practitioners would not be able to do this. But actually, they were happy when we provided them the solution. Oh, and by the way, we assumed that the W's are known in advance. Here, as you can see, they are not necessarily parameters anymore. We can leave them as variables. That's the key trick, so that this works. But it's a pretty challenging task, and there is a solution for it. Constraint attribution is something that we also applied in terms of explaining how different constraints actually affect the optimization process and the optimized portfolio. I don't want to go too deep into it. There is this notion of implied alpha, which is kind of the reverse optimization. If you would use the implied alpha in an unconstrained optimization, then you would get to the same portfolio. That's the idea behind it. And again, optimization theory here in the form of optimality conditions, those are the simple Karush-Kuntaka conditions, you can now derive interesting decompositions of differences that are important for the practitioners. So here you see the implied alpha, here you see the alpha they used, and then a linear and consistent decomposition of how each of the constraints applied, together with the dual value, their sensitivity, have actually affected that difference. And you can translate this into other spaces like the holding space or the expected return space, and you get meaningful decompositions there. that explain actually how your portfolio solution is sensitive against the constraints you put in. And then there is something that we use, which is called robust optimization. I like always to introduce this by this nice quote: planning is the replacement of chance by error. So we avoid the chance, but we still have the error and we need to control it. So what we do there, just in brief, because time is flying, is that you would definitely not pick the higher return asset here, because it's fat tails are much bigger, right? You see the green line, and you see it's very uncertain that you actually get that return. Whereas the other slightly smaller one is much more certain. So that is actually exactly the interplay on risk and return that you need to take. Here's another experiment. We take two different alpha predictions. They are just different by 1 basis point. We call it 0.01% is 1 basis point. And if you apply them to different scenarios, then you get quite surprising results. If you apply it in a long short case, where you can short assets and so on, taking those two different alphas leads you to basically the same portfolio. The differences in the solution weights are marginal. But if you apply the same now to a long only, which seems to be the simpler approach, then you will be surprised. But you see that exactly the same input data lead you to very, very different portfolios, differing by up to 50% in weight. And the reason is simply that, obviously we have the constraints here, the budget constraint, and the alpha has been constructed for that example clearly to tilt around this constraint. And so it drives you into corners, and in this case, they are quite far apart, right? So this is one of the shortcomings of optimization. And now how can we deal with that? One thing that you can do is you can look at taking the estimation error into account. And then you use something that's called robust optimization or robust mean variance optimization. And it's interesting to note that Markowitz actually has commented himself already in the very beginnings, where robust optimization was not yet even visible, that the differences in estimation errors should be taken into account. And so this is what robust optimization does. You can define the uncertainties, the estimation errors, in different ways. The box uncertainty is actually something you can model linearly. Or you can say they are connected, and then you use an SOCP model, so you use an ellipse. And if you think about that in game theory or in online optimization, you could think, I give you a portfolio based on some return estimates, and then the adversary can change the return estimates to make it look as bad as possible, right? And in this case, if you look at the elliptic one, different from the box, where every deviation from the assumed alpha can be independently to the maximum extent, independent from all other instruments, here we have linking, right? Because I can only in sum deviate the alpha up to a certain number of standard deviations, but not more. And I need to think how I do this. And then you can even go one further step to reduce the conservatism, which is this zero net alpha adjustment, which means that you, in addition, ask that all deviations sum up to 0. And the economic meaning or intuition behind that is, why should you assume that everything always goes against you maximum? There will be always things that go for you. And you can do this by requesting simply that the adversary has to zero net out all the adjustments it makes. So that's behind this theory. And that's just a rather technical slide. It only means that what we do here is we turn a maximum return or expected return optimization into a max-min optimization. So we want to maximize the worst case, taking all those estimates of returns from our confidence region into account. And this leads to the following effect on efficient frontiers, which is that it brings them closer to the true frontier. You know already the dark blue, the green, and the pink line. What you see now in light blue and orange is if you apply robust optimization, then you see the light blue line is the robust frontier, and it's much closer to the true frontier. It can actually even underestimate the return there. And if you then apply the realized returns on that, you get to the yellow line, but you see this is now pretty much, at least more close to the pink line than the green. And this is what robust optimization actually can have as good benefits here. There is also multi-portfolio optimization where you don't optimize at each point in time for itself, but you go over the entire evolution at once. And here is the model that we have for that. I don't go through details, but it's a classical model where you include time as an additional index to each of the variables and to the data. And you run the portfolio forward, you apply the returns, you might have cash flows and so on. So this is the model that we use, but it's actually a deterministic model. It would be nice to get some more stochastics into it. And that leads me actually to the point about, what is there still to research? What are the challenges? So one point is, of course, you will always struggle with solving problems that are, just complex enough formulated. So here is an overview of especially the combinatorial aspects that I've mentioned that are important for practice, and how difficult or simple it is to solve and deal with them. As you can see, thresholds are the most complex ones. Why? Because this is a discrete decision per asset that you handle, and since you have often 10,000 and more assets in your problem, you actually get so many discrete decisions, and it's not easy to tackle them. Tags, counts are usually a little easier, but then the others, as you see, are somewhere in the middle, and it depends always on the data. But what is very tricky is round loading. This is this trading in only discrete amounts, and that's really turning it into a combinatorial problem, and that's very, very hard to tackle. We have then other issues that you usually encounter in solving problems, which is symmetry, poisonous for optimizers. You have tightness, if the problem is too tight, and it might be even numerically difficult to find solutions. You have degeneracy that makes progress in optimization processes difficult. So all those issues need to be tackled here as well, of course. But that's where we have such specialists like myself or my colleagues that can help our clients in tackling those. What we can't do is generalized methodologies. That is where research is asked. So that semi-definite programming is something that is, of course, researched a lot, but we don't think it is yet fit for real-world problem sizes. It would apply if you would also try to introduce estimation errors into risk models, which are those matrices. Then you end up in semi-definite programming. But what we have seen so far is that, as I said, for 10,000 assets or so, you still get to the limits. Optimizing higher moments is something that is in demand in the industry. So mean variance is only accounting for the first and second moment of return distributions, but skewness and kurtosis should also be handled and then looked at. Especially if you go beyond equities, then this becomes more and more important. But there are not yet good solutions for that. And then stochastic optimization, as I mentioned, we can't optimize value at risk, which is a stochastic term. We can do conditional value at risk or worst case value at risk, which are promising approaches to tackle it, but we can't do for VAR. I leave it at that, but those are the methodological challenges. And then online optimization is something important for trading, because this is very much an online process, and so there are trade execution problems, and our optimizer is used at some places, for instance, for trade scheduling. But you can always, of course, drive that further, make the time grids finer, and so on, and up to the point that you end up in so-called high-frequency trading, which is really running the full trade show by algorithms only, and humans only overview the algorithms and how they do, but they are not taking any of the steps anymore. And that is obviously quite challenging because it needs to bring together the right concept with the right solution technology. Okay, now finally, I make it short. Who shrunk the alpha? Well, what shrinks alpha is, on one hand, of course, if you have wrong predictions, bad bets, if you are too risk shy, if you have a too high risk aversion, or if your funds, for instance, by your darling, are spent somewhere else and you can't put them into the names that you have researched. But what's more serious as a comment is obviously there can be adverse economic environments, like, for instance, the zero interest rate environment we have now, or markets that turn against you. And in finance, you call this typically the unexpected bear, which you show a picture of. Now you see a picture of. There are other things. There's geopolitical trouble. You can figure that it's a good idea to invest into something, but then politicians make scratch that idea off. If you consider these days to invest in UOY, I would think twice, because there is simply politics stepping into it, and you might not be able to take the benefits out of it. And then there is, of course, the mix of both, when economics and politics come together, and you see some examples here that affect heavily what happens on the markets, has been partly unforeseen. And you might find yourself on the wrong side of the game if you have invested in some companies that behaved not properly. But then there is also another shrinking. Robust optimization can actually be considered as a shrinking approach. Here is the formula that you can apply here, and then you see this is the shrinking of the portfolio towards a market prior, as we call it. I don't dive into the details here, but it's a shrinkage approach, and it shrinks the alpha, and it does so intentionally just for protection. You don't want to expose yourself too much into the alpha. So that is something. There are other methods like Black Glitterman and so on that can be considered shrinkage as well. But that's something that practitioners want to avoid as much as they can, obviously. So in the conclusions, basically almost all of the people here, I would take out George Danzig. He put out optimization, and this is a great tool heavily used in the field. But basically all the other things are shrinking your alpha, and that's something that concerns the financial practitioners.